Now, what I'd like to do is go over aspects of this chapter, pause, do a problem. Go over aspects, pause, do a problem. I think there's just so much to cover, so let's just take it in little bits and work through some of the problems associated with the questions. This is really a continuation of the previous week where we're learning about manufacturing or merchandising companies and how the financial statements are a little different. What we're going to talk about this week is how we allocate for inventory. There's different methods we can use for how we allocate in the cost of inventory. We're not dealing with really the product flow, but we're dealing with how we show it on the financial statements. So it's not a difficult chapter, but we're going to go through problems, okay? And I'll let you know on what I expect you to know for a problem on the quiz. Yes?
Just like a little after, just to, before we go over some of the homework problems from chapter 5, I emailed you saying that I was having some difficulty on some, if that's all right.
Absolutely.
Or just some like them. We don't really have to
Let's take that time and do that right now, guys. Okay? So which problem? Let me get in here.
I think it was like 7 and 11. The ones you had to use the information given to find like information.
Oh, fill in the blanks.
Just fill in the blanks. Like,
Okay.
I know I had to figure out like part A, but then there was like the unique or news company that I really just I just didn't know how to.
Absolutely. And what I also will do, that's chapter 5, and the homework solutions, let me just edit those so you can have them. Restrict access.
You're getting pretty good at this middle thing, aren't you?
I am, aren't I? You guys are.
You're making
Okay.
the business law teacher look bad.
Okay, so let's go over
Yeah.
financial accounting.
Post your answers and like, you can't. People showed up for class last week. Half the people thought there was a quiz because he's got a quiz on the front of the thing.
Now, who is that?
I've got a business law teacher, and so it was an old thing, so then he sent out an email saying there's no quiz, but you would have had to read the email to know that there's no quiz.
And most people don't. Like, sometimes the Oxford email doesn't
Yeah.
really, yeah.
It's like, no quiz. I think there's says quiz today.
Yeah, it was like 264.
I mean,
Thank
it's anyway,
you.
so it's like,
Okay, 264, and we're dealing with
But the
munis.
first one was number 7. I think.
Okay, so let's
Yep.
look at 7.
Nunes.
Okay. So for this problem, we want to fill in the missing amounts, show all computations. Okay, so it shows us here, it gives us some information, but not all of it. It tells us that our gross profit is $40,000. Now we know our gross profit minus our operating expenses is going to equal our net income. So if we take the $40,000, subtract from that our net income of $17,000, then that means our operating expenses need to be $23,000. Okay, $40,000 minus $23,17. We also know that if our net sales are at 100 and our gross profit is at 40, the cost of goods sold needs to be 60. Because we're taking 100 minus 60 is going to be our gross profit. Does that make sense? Then, when we deal with net sales, they're telling us our net sales are at 100. If our sales returns and allowances is 5,000, that means our sales revenue needed to be 105. So basically, we're plugging in the different numbers by taking what we do know and using the numbers on both sides of them to determine the variable. Does that make sense? The same thing here with Yannick. If our sales revenue's at 90 and our net sales are at 84, then that means the returns we had from sales have to be 6. If our net sales are 84 and our cost of goods sold here is 58, then our gross profit is the difference, or 26. Then if our gross profit is 26 and our operating expenses are 14,380, then that means our net income needed to be 11,620. Am I getting the numbers fairly right? Craig, we were worried
Craig.
about you,
Right.
but we know you travel a ways. Does that make sense, what I'm doing there?
Thank you.
Now, what other problem do we want to go over? Any others from the homework for Chapter 5? Are we good? Okay, guys, so we're going to start on, now we can begin class.
Now that
Because
Craig is here.
we had to wait for Craig. Because it's all about Craig. So, guys, we're going to talk about inventory. We're going to go through pieces of the PowerPoint, take a break, go through pieces, and do problems. So, basically, in Chapter 6, we're going to talk about what's included in inventory. And there are, based on the guidelines of how we recognize inventory, we're going to talk about the things that should be included and those things that aren't included. And then from there, we're going to talk about how we account for inventory. When we sell a product, of course, we probably sell the oldest one in there, just to get that out. But for purposes of financial reporting, there's different methods we can use as to how we account for inventory. Some of the terms you're going to get used to is FIFO, LIFO, average cost. FIFO usually means the items that came in first are the items we're going to show we sold first. First in, first out. LIFO, last in, first out. We're going to go through all these things, and then from there, basically go through problems. So, when we're dealing with a merchandising company, such as a Target, a Walmart, a Gander Mountain, they do not produce their own goods. They purchase them from a wholesaler. So they bring in inventory for resale. And so a merchandiser only has one type of inventory on their books, called merchandise inventory. Pretty simple. They pay for goods, and then when the goods are sold, we account for that under cost of goods sold. And then at the end of the period, so much is cost of goods sold. Another grouping is the inventory left on hand. So we're going to talk about what should be included and how we calculate cost of goods sold. Manufacturing companies can become a little more challenging. If you think of a company that produces its own goods, they start with something called purchasing raw materials. They might have bolts and screws and wood and metals and aluminum. And those are raw materials that they purchase. Then when they're ready to begin producing, they take those raw materials from their warehouse and they bring them into something called work in process. They begin working on products. So in a manufacturing company, you have inventory that consists of just raw materials. They're waiting to be used. Then you have a section called work in process. Those are goods that are in the process of being completed, but they're not done yet. And so we're going to keep into account that work in process of inventory. Then lastly, once the inventory is totally completed and done, it's ready to be sold. So that section goes into something called finished goods. So a little more complicated than just a manufacturing company, but truly it's not difficult. It's just instead of having one section called merchandise inventory, we've got 3 different sections. So we're going to go through the scenario of how we show this. Now, we've talked about 2 different methods that can be used for accounting for inventory. The perpetual method is a computerized method where they keep track of the inventory after every sale. So after every sale, that inventory is shown as cost of goods sold. And so at any point in time, they can get on their system and know technically what's in inventory and what's been sold. Usually these individuals do perform a year-end physical count. I had a client in my class last night, and he works for, begins with an S and I can't remember what the name is. But he works in a warehouse, and they run a perpetual inventory system, and they usually do a physical count at year-end. Over the past 2 years, their variance between the perpetual on the system and their physical count was a difference of 0.01%. Therefore, they're no longer going to be required to do year-end physical counts. Now, this is an inventory. Obviously, they have very good internal controls. Nobody can get in there. And so, because of the cost of doing a year-end physical count, for that specific location, they're not going to be required to do it anymore. Makes total sense to me. Probably in stores, you will always have to do physical counts because there are fingers that want things off. And you have usage or wear and tear. The periodic system is such that you don't ever really know where you stand till the end of the year. You put everything into purchases, and then at the end of the year, we will take a physical count of what's on the shelves, and the difference is inventory on hand. So the rest is going to be under cost of goods sold because it's no longer here. So know that the periodic inventory is basically a one-time deal. All the purchases get applied to purchases, and then at the end of the year when we determine what's available, that's how we then determine our cost of goods sold. The perpetual system is much more up to date. You always know where you stand. So in taking a physical inventory, you basically, technically, really need to count every item. It's time consuming, it's cumbersome, and you have to do it at a time either when no one's in the store or it's very low, there aren't a lot of customers in the store, because you don't want that to then skew your numbers. A lot of times people do it over New Year's. I know you can kind of see even with Walmart, they take areas of inventory and they just, at night, will take certain sections and count it. So basically, it has to happen, it needs to happen at the end of their fiscal period, whenever that is. And it really needs to be a downtime in the store so you can have an accurate reading. Now, one key with how we determine what's in inventory is we need to understand when the ownership transfers from a buyer to a seller, or from a seller to a buyer. So when we're dealing with inventory and we purchase goods, depending on the terms of the arrangement determines if we own these goods or not. Sometimes we can have goods that we own, but we haven't received them in our warehouse yet. Why would we still own those goods even though we haven't seen them?
Because we paid for the shipping.
We paid for the shipping. The shipping contract said FOB shipping point, free on board to the shipping point. There are times also when we may show goods in our inventory, but they're really not our goods because we sold them, but we just haven't sent them out yet. So there are a couple complexities to making sure we're accounting for the right things. In one of my classes, it's an auditing class, and one of the portions of it is it's like a big project. And in the project, it showed from year to year what the profit margin was for the goods they sold.